For most of human history, the average growth rate in the money supply was right around 1.5%. This is because money was gold for thousands of years. And so if you wanted more money, you'd either have to just sell something to get money, or you'd have to go dig it out of the ground. Now you might think, well, why would everybody not just go dig money out of the ground? And it's because that costs money to do that. So if it takes you more than $1 to get $1's worth of gold out of the ground, then you're not gonna do that. Because of this, the growth rate in the total supply of gold was relatively stable over time, around 1.5%. But with the invention of fiat currency, this game changed. Suddenly, the money supply was able to expand at record paces without anything forcing it to contract again. But something is happening today that hasn't happened since the Great Depression. The money supply is contracting again, and it is currently shrinking at a rate faster than it's shrunk since the Great Depression. So why is the money supply contracting so quickly today? What are the consequences of this? And most importantly, what will the Fed's response to these consequences be? Real quick, a word from today's sponsor, McAlvany Precious Metals. It's no secret that today banks are falling like dominoes. So the question is, how do you know if your bank is safe? In times like this, the name of the game is always counterparty risk, which is essentially just the degree to which you have to trust or rely on somebody else to give back to you what they promised they will give to you. This is why investors like investing in things like physical gold and silver, because if you have it, you don't have to trust that somebody else will give it to you. This is not the case with banks though, which today means many people are asking the question, is my bank safe? Can I trust my bank that they'll give me back the dollars that they owe me? This is where the McAlvany Trusted Precious Metals Advisors come in. Right now, they're offering a free consultation with you in order to go over your bank and provide you a detailed analysis on whether your bank is stable and safe. They do this by providing a bank safety rating, which is a composite of hundreds of factors synthesized into 5 indexes: the bank's capitalization, asset quality, profitability, liquidity, and stability. Putting these all together, you can see what your bank is invested in to learn whether your bank is safe, is stable, and has the liquidity that it needs. This will give you the information you need to make an informed decision about what you should be doing with your portfolio and your investments. The expert precious metals advisors at McAlvany Precious Metals are here and ready to assist you in analyzing your bank, looking over your cash holdings, and making individual personalized recommendations for you about your investments. Sign up for your free bank safety rating consultation with the link in the description below. First, we have to take a look at how money used to work. Now, I mentioned before that the total supply of money on average increased about 1.5% over time, because that was the rate at which people dug gold out of the ground. But it's not entirely accurate to say that this is exactly what the money supply did as well. This is because currencies backed by gold and credit payable with gold have existed as layers on top of the gold money supply for as long as human history has been around. And because these currencies and credit operate themselves as a form of money, the broad money supply actually can expand rapidly faster than the gold supply does. This is why when we look at a long-term chart of the money supply, even during the 1800s, we see sometimes the money supply was expanding at upwards of 10 to 20% per year. But the key thing to understand about this is that when you do have an expansion in a money supply based on credit or based on a currency that is backed up by hard money like gold that can't expand, then you have to have a contraction in the money supply after the expansion. And this is exactly what you see happen all throughout the 1800s here. Yes, you had an expansion in the money supply, and then you would always see a subsequent contraction in the money supply. Because if the money supply expanded as a result of new loans being made, a credit expansion, well, then eventually that debt gets paid back. And so the money supply expands from the debt and then shrinks again when the debt gets paid off. And if you have a currency that is backed by gold and you try and just expand the supply of that currency infinitely without ever shrinking the supply, well, eventually you get hyperinflation, people stop using the currency, and the money then reverts to gold, and so the money supply again goes back down to what it was before. It contracts back to the gold supply. So on average, the money supply actually did maintain a growth rate of right around 1.5% over time, even though it was volatile. You had the expansions and the contractions equaling an average of like a 1.5% over the long term. Since the growth rate of wealth during most of human history was higher than 1.5%, what you ended up having was natural deflation that took place over time. As the total stock of wealth grew at a faster pace than the money supply grew, prices went down over time. But something changed in the early 1900s that gave us the first Great Depression. In 1913, the Federal Reserve was established. This allowed the money supply through credit to expand at a much faster pace in the United States. That led to the first Great Depression that happened in 1920 in the United States. As you can see here, the money supply expanded rapidly up until about 1916. It continued to expand at a rate of about 13% until the end of 1919, when the money supply fell off of a cliff. So the Federal Reserve was established in 1913, and that allowed artificial credit expansion. That created more money. People spent that money feeling rich. Prices were bid up. And then everything unwound when that credit boom started to collapse. This led to the first Great Depression. Jim Grant wrote a great book about this called The Forgotten Depression. It fixed itself within 18 months because the government did absolutely nothing to try and save the economy. It just let it play out, and play out it did. But the Fed obviously did not learn their lesson, because in about 1922, they began artificially expanding credit again and allowing interest rates to be lower than they should be. This created another boom in the money supply, and the money supply started to expand rapidly throughout the late 20s as well. This increase in the money supply had the same effect as before. Artificially easy credit conditions allowed people to spend more and more money, accumulate more and more debt, bid up prices until the whole thing starts to unwind, and you get what we now call the Great Depression starting in 1929. This time the government did try many things to try and bail out the economy and save things and make things better, and ultimately they just made things worse, and this depression lasted a lot longer as a result. The money supply growth rate continued to fall after 1929 and hit a bottom of about 12% in 1932, meaning that in 1932, the total money supply contracted by about 12%. This led to severe deflation. And so obviously we know that when money is printed rapidly, that means prices are going to go up. When the money supply shrinks, there's less money to go around, less money for people to spend. So prices have to adjust downwards, sometimes very quickly, in order for people to continue to afford them. Otherwise, people just can't buy them. This creates a downward spiral where people have less wages, less money to spend, less ability to continue to afford things at those higher prices. So those prices have to fall, and then there's less income for whoever is selling those products. And again, down and down and down it goes. But this kind of deflation is something that the world has not seen for almost 100 years. The Federal Reserve took a good look at the Great Depression and said, no matter what, we do not want this type of deflation to ever happen again. So we'll default to inflation as much as we can so that we don't get anywhere close to that deflation ever again. And starting in 1971, the Federal Reserve got their wish because they no longer had an anchor on the amount of money they were creating. The total money supply since the 70s has been on a steady and increasing pace, higher and higher and higher. You no longer have the necessity to have the money supply contract because there's nothing that needs to get paid back at the bottom layer of the money. There's no hard anchor like gold. You can simply expand the money supply as much as you want, restricted only by political will. And that political will was tested in 2020. And because it had been so long since the United States had experienced any meaningful inflation numbers, the Federal Reserve went overboard with their expansion of the money supply. Never before in American history had the growth rate in the money supply reached the 27% that it reached in 2021. In addition to that, the rate at which the growth rate of the money supply increased had never happened in American history. Just in case you don't understand the gravity of what that number means, it means that within 1 year, 27% of the money that was in circulation had been created that year. Absolutely unprecedented, especially for an economy that controls the global reserve currency. But after the money supply peaked in April of 2022, the Federal Reserve started to shrink the money supply, and it has been on the decline since. In fact, the last time that it was this low was in September of 2021. Most people don't understand the gravity of this situation. The money supply shrinking is something that has not happened in American history since the Great Depression. There were a few times in the 90s when the growth rate approached zero. There was also a brief point of time in 1959 where the growth rate approached zero. But the last time the growth rate was negative, meaning the last time the money supply was shrinking, was during the midst of the Great Depression. But where is this money actually going? If the money supply is shrinking, where to? Well, very simply, that money is actually being destroyed. It is no longer in existence. So how does this work? Well, when new money is created, it's created through one thing and one thing only: new loans. Many of you are aware of this, but when a bank makes a loan, that is not a transfer of money from one person's bank account to another person's bank account. When they create that loan, that money is created out of thin air. It's the same with regular banks as it is with the Federal Reserve. When the Federal Reserve creates new money, they do it by loaning it to somebody, most of the time to the United States government. So if the only way new money can come into existence is by a loan being created, that means when a loan gets paid off, then that money ceases to exist. Now, looking at the chart of the money supply over the last few decades, you might be thinking, well, does that mean that loans were not being repaid during that entire time? And the answer is no. Obviously, some debt was getting repaid. But on net, if I repay $1 million worth of debt while somebody else gets out $1.1 million worth of debt, then the net increase is $100,000. And so yes, for the last decades, since the Great Depression, the net growth of the money supply has been positive because of new issuance of debt. But now with the money supply shrinking, this is happening because debt is getting paid off. Right about now, you're probably asking, whose debt is getting paid off? Because it's certainly not household debt that's getting paid off, as that has continued to rise. It's also not the government's debt, as the national debt has continued to rise. The answer is it's the debt held by the Federal Reserve. If you look at the Federal Reserve's balance sheet, you can see that its total balance sheet has been on the decline since April of 2022. And it's no coincidence that that also marks the top in the money supply. Essentially, the Federal Reserve is allowing the debt that it owns to get repaid without rolling it over. And since the Federal Reserve owns primarily national debt, meaning the United States government owes that money to the Fed, that means that the national debt is having to seek other lenders as it grows. So instead of the Federal Reserve continuing to loan money into existence by loaning it to the federal government so the federal government can use it to pay for its expenses, the Federal Reserve is saying, no, I'm going to let you pay me back for that old debt the last time I loaned to you, and I'm not going to loan any more to you. This means the federal government is having to seek other places to borrow money from, and it's making its borrowing costs go up. And here's where we get to the main consequences of the money supply shrinking. We know that if the money supply grows at a faster pace than the wealth grows, then you'll have inflation. Prices will go up. You need more money to get the same amount of wealth. On the flip side, if the money supply starts to shrink, then you will get deflation. You need less money to get the same amount of wealth. Less money to go around, prices drop. As prices drop, what that means for the federal government is less income, because they get money by taking it from your paycheck. So if your paycheck goes down, they get less money. They also get money by taking it from corporations and how much they sell. Well, if they're selling less or selling lower priced items, that means the government gets to take less. The government also gets to take money when you sell a stock at a gain. But with the stock market falling over the last year and a half, there are not as many gains to tax. This means that while the Federal Reserve is actively making the federal government pay them back for the debt that they've borrowed from them, the federal government is at the same time having to borrow even more from the rest of us because their tax income is a lot lower than it would have been otherwise. This led the Congressional Budget Office to recently have to update the amount that they expect the deficit to hit this year. That is $0.4 trillion more than the projection was in May of 2022. And considering the deficit in 2022 was $1.3 trillion, with an absolutely staggering $405 billion of total taxes for the government, that $1.5 trillion deficit may be an underestimation, especially considering as the government needs to borrow more, that means interest rates are going to go up. Their credit risk increases, but also they're taking more money out of the economy right at a time when there's already less money floating around for everything that people need. So the appetite to loan to the government goes down. They require a higher interest rate to be able to make that loan make sense. Mark Moss recently tweeted out this chart, which shows that US interest payments are now about equal to defense spending. And you can see it's basically a hockey stick as the interest payments are just skyrocketing higher. Former Fed insider Joseph Wang recently tweeted out this chart, which shows that the government itself projects that $1.5 to $2 trillion will need to be borrowed every single year for the foreseeable future. Quick recap. The money supply is decreasing. That means there's less money to go around, which means prices are dropping. The main consequence of this means that borrowing costs are skyrocketing. The biggest debtor is the United States government, and so their biggest expense is now going to be interest very soon. This will become more and more expensive as time goes on. And left alone, it will mean default. So what is the policy response likely to be? Because this is where the real danger happens. I spoke with Peter Schiff recently about this, and he talked about how the honest thing, the beneficial thing, the most healthy thing to do would be for the federal government to honestly default. Because if they do just honestly default on their debt, then there's some sort of restructuring, some sort of resettlement, and then their credit risk would actually go down over time, because after the resettlement, the restructuring, and the, maybe they pay 50 cents on the dollar, well, they're actually able to afford their bills again. But the other option is a technical default through inflation. It means if they owe $1 trillion, they pay $1 trillion, but it can only buy $500 billion worth of stuff from last year's prices. And unfortunately, this is almost certainly what the policy response will be. We're likely to see the Federal Reserve respond with laser-focused bailouts here. We've already seen this with bank bailouts. The financial crisis in 2008 was blunt force instruments. 2020 was an even broader application of sledgehammers, of lowering interest rates for everybody, giving free money out to everybody, bailing out the whole economy, and unfortunately that resulted in record high inflation. Powell is not going to repeat that mistake, especially with 2020 so close in the rearview mirror. Instead, they're applying a more laser-like, a scalpel-like approach to the failures that we're starting to see crop up. With the bank bailouts, it's make sure the depositors keep their money, but let the banks fail. Don't lower interest rates across the board. Don't restart QE, but we'll do a couple emergency loans to the banks that are most in trouble. And when the federal government gets in trouble, you can be almost certain that the Federal Reserve will do the same thing. If they can't pay their debt, the money will get printed for that, but it's not going to come through to you and I. It's not going to be stimulus checks. It's not going to be universal basic income. It's not going to be lower rates for everybody. The Fed has been very clear that they want to keep rates around 5% for the foreseeable future, which means this inverted yield curve showing the market's expectations that the Federal Reserve will lower interest rates soon is likely dead wrong. In the name of stability, the Federal Reserve will inject cash exactly and only where it's most needed, which in the near future will probably be the federal government. And until inflation drops and stays low for a significant amount of time, we are unlikely to see anything else. The last thing that Powell wants is to pivot too early and reignite inflation and have to start the whole thing over again, like happened multiple times in the 70s. In summary, the Federal Reserve is actively shrinking the money supply, causing economic pain for everybody, trying to push prices lower to stop inflation. This is causing acute, very severe economic pain for certain individual actors like necessary banks and the federal government. And as those systemically important institutions get into too much pain and are at risk of failure, the Federal Reserve will bail them out, but only them. And that bailout will not be spread far and wide and shared by people like you and me. So buckle up, strap in, and prepare for a bumpy ride. As always, really appreciate you guys. Thanks so much for watching. Have a great day.